Alroy Lobo, Chief Equity Strategist and Head of Equities with Kotak AMC, joins us live. Alroy, morning. Thank you for joining us. Alroy, now there is no mystery in why globally things are looking twisted and why locally we are underperforming. But at the current juncture, do you think markets are pricing in all the bad news?
I would say that if you divide, the market into two components in terms of the influences, one global and one domestic, I think largely the domestic issues are now getting well priced in at these current levels. The global issues, in my opinion, are still not completely priced in. There's a lot of uncertainty around there. And should we have an adverse event in Greece, where Greece exits from the euro, then I think the market can definitely see lower levels. But if you were to exclude that kind of an event and exclude also the fact that you're going to be having potential uncertainty coming from the Spanish banking crisis, then domestic issues, in my opinion, from an India perspective, are largely getting priced in at current Sensex levels.
Alroy, so what is the best way to put money to work in such an environment? Because if globally things go wrong, we could be staring at a downside, and the downside could actually be very, very harsh in nature.
Yeah, that's right. In fact, at this point in time, I would basically, wait for some events to play out. It is better to sort of invest at slightly higher levels when these events are out of the way than to basically catch a falling knife should these events really, pan out. Having said that, our view is that there is a potential downside of around anywhere between 15 to 20% should you have, events like a Spanish banking crisis or a Greece, pull out from the euro. And that is the reason I believe that some of these events need to play out, because the risk reward otherwise would be unfavorable. I would say another couple of months from now there would be a little more clarity. I think policy action would definitely be expected by the ECB, and also from an India perspective you could see further policy action. So once these events play out and you have a little clearer window, that's the time one can take a more constructive view on markets.
Alright, that's precisely the point. How soon could the interest rate cut actually come about? Because since yesterday, the murmurs are only getting louder that perhaps the RBI is going to cut rates as soon as in its June review, and the crude price, or rather the significant cool-off with the crude prices, is only making the case stronger.
I would say that it's a tough decision for the central bank. On the one hand, you're right, growth is slowing down and crude the prices are falling. However, you have to also appreciate the fact that we have high fiscal deficit and a weakening rupee, and this counterbalances those effects. So it will be a tough decision for the central bank. Having said that, the only tool available now for revival of growth is monetary policy. I don't think we have enough elbow room left as far as fiscal policy is concerned. So monetary policy is the only way to go to revive growth, and I would believe that it will be more measured, and over the next maybe 12 months, you could see at least about a 75 basis points for the cut in interest rates. But I think the key issue is not policy rate cuts. The key issue is whether it gets translated to lending rate cuts, because that's where it starts impacting industry.
And why do you think industrial growth, or for that matter private sector growth, will come back because of a rate cut? Because private sector investment is also a function of sentiment, policy and the environment.
So there are few, if you were to divide the economy into multiple sectors, the first sector that really benefits from an interest rate cut is basically leverage consumption plays. And that, in my opinion, is a very direct beneficiary. The second is clearly, companies where you see leverage, but they're not really in the investment sector, but they're basically having a very high cost structure because of taking debt on their balance sheet. Those sectors will definitely do well. And the last is clearly the investment sector. The investment sector requires far more than just rate cuts. I agree with you. It requires far more execution to be seen on the ground for that sector to really recover. In that context, I would believe that some part of the economy, which I mentioned, the consumer discretionaries, the leverage consumption plays, those are the ones which would actually give a fillip for growth.
Alroy, do you worry about global liquidity at a time when global risk of trade has started? Investors are pulling out money from bonds, equities, emerging market equities, and it's a matter of time, foreign institutional investors will reduce allocation to India?
Liquidity is very difficult to forecast, and it changes very quickly. And just when you are, very bearish on liquidity, liquidity can turn to be very positive. And it's all a function of whether the country you're investing in or the stocks you're investing in, are they attractive from a valuation standpoint. I normally see that, things tend to self-correct. So when the market tends to fall, money is moving out of the country, then valuations get very attractive, and again, money returns back to the country. So liquidity cannot be, soft for a long period of time. It will return to markets when the valuations, reflect the fundamental scenario of an economy. In that context, a slowing liquidity environment clearly is creating a high amount of impact costs on stocks. So it's very difficult sometimes to liquidate certain positions at the price you want to liquidate it, and so the clearance prices are definitely far lower than what they would otherwise trade at, and that is the kind of impact on liquidity. And my view is that wait for a couple of months. I think it's a reflective of the scenario globally, where people are going through a bout of risk aversion right now. Once the air clears, the money will once again come back.
Alright, what about the constant parameters that the market monitors? Earnings, for instance, do you think they've bottomed with what we've seen in Q4?
I would say, earnings is going to be difficult to project for most analysts in the market. And the reason being is when growth slows down, you normally find that the operating leverage tends to act against you. And most analysts tend to still, have in their earnings models what we call as a variable cost model. Whereas a lot of companies have a pretty high fixed cost structure. And when growth slows down, the impact on earnings is far more severe. In that context, you have been seeing an earnings downward revision. I don't think the revisions are by and large over from an analyst community, but the market has already factored that in, and market already knows that this is the kind of impact, and that's the reason you're getting India at these valuations today, which are pretty attractive, only if you were to discount the domestic issues. So to that extent, I would not be worried on the downgrade cycle, because I think the market is ahead of the downgrade cycle. What is more important is what are the steps going forward. And there are several things that can happen which are positive, which the market perhaps may be ignoring right now. For example, it is quite possible and very highly probable that there will not be a Greece pullout. And it doesn't make sense both for Greece or for Germany or for that matter the entire Eurozone. And I think all attempts will be made to make sure that Greece is part of the Euro, in which case you could have a short relief rally. Second thing is on the European Central Bank. They are clearly aware of the Spanish banking crisis. They have some firepower which they can unleash. And perhaps once that is done, the market will be far more they take a very positive and constructive view once those events go through. In such a scenario, we'll have to then shift eyes back to the domestic market to see what the Indian government has done on the policy front, and as far as investments in particular. And I think the focus is clearly trying to see whatever they can do as fast as possible, because they do realize that it's investment slowdown which is actually causing the growth slowdown. And once that really comes back, you will see far greater interest from foreign institutional investors into the Indian market. So I'm a little more optimistic that they still have a 2-year term ahead of them, and they have a lot to do, and they will go ahead and make those hard decisions now.
So Alroy, the script of how Indian markets moved in the month of May was largely influenced by 3 factors: rupee, US, and then to a large extent Europe. What to your mind will influence the script of how Indian markets will move in the month of June?
Like I said, we have the Greece elections, the outcome of which is on June 17th, so that's going to be very critical. And the response of the central bank in Europe, as well as how they address the issues of the impending Spanish banking crisis, will be very, very critical for investors. Clearly, the tools available are not too many, and they have to be clearly cognizant of the fact that they don't do something which will have longer term implications. So they will be far more measured. I think they're likely to see a few measures which may come into place. Clearly there is going to be a rate cut in the Eurozone that would definitely happen. There is talks about a possible deposit insurance, a wider deposit insurance scheme that would be unleashed to make sure there's no withdrawal or a flight of capital from the banks, particularly banks in Greece. So that is something. The LTROs would continue, and I think only the issue is, what Europe really requires is labor reforms, and unless that is pushed through, this problem in Europe, in Eurozone, will basically, continue. And we also require a fiscal union in Europe, and the faster we, converge towards a fiscal union, the better it is. So I think some of these steps will be taken. They all realize the implications of all this, and I think consensus will have to be built in making sure that we avert a kind of a crisis in Eurozone.
Alright, the street currently is divided on how should investors approach consumer names. The bulls are of the view that consumer names are growing, they are defensive in nature, and these companies have strong return on equity. Now the naysayers are of the view that consumer stocks are expensive, just about everybody is hiding in some of these consumer names, and that trade is getting crowded. What is your stand?
I would agree with the fact that valuations in the consumer sector are rich, but as long as you don't have an alternative for an India-dedicated investor, consumer sector, in my opinion, will relatively outperform the other sectors. The way to approach the consumption sector is to be focused on companies where the demand drivers will continue, because the demand for those products are relatively inelastic. So that's the first filter that investors can look at. Second is to look at companies where you're seeing visibility in terms of growth. Perhaps they are in segments where they're catering perhaps to the premium segment, where the wealth effect is at play rather than the income effect at play. So that's another area to really focus on. But by and large, I would say that if you have a consumer company which is producing high return ratios, high free cash flows, in a market like this, it's very difficult for investors to stay away from that trade. And this trade can only reverse if you have an alternative in terms of other sectors, and we're not seeing those alternatives right now.
Alright, what did you make of the petrol price hike that we've seen, and how much could it lend credibility to the fiscal deficit target, or do you think a diesel price hike is what we actually need?
I think there is no doubt in my mind that they now have to catch the bull by the horns and go ahead with these price hikes, because otherwise the economy itself would face issues. As you're aware that the subsidies are the biggest cause of a high fiscal deficit, and unless you pass on the prices of high oil prices to the consumer is not going to stop consuming. They need to understand the fact that this is a scarce commodity, and it has to be used wisely. And if there is no change in price, then they would not basically feel the pinch. So I would expect that they would have to push through these diesel price hikes and petrol price hikes, which is positive from a fiscal deficit perspective. And we can't really look at it very narrowly. We look at it from an economy perspective. The moment subsidy issues get resolved, there will be a lot of interest from global investors into the market, because now they know that the government is willing to take those hard decisions. So we are pretty positive on the fact that at least they've been able to get a reasonable price increase on petrol prices, and going forward, we would see perhaps more attempts. The longer-term solution is clearly using the unique identification number to make sure that you have direct cash transfer of subsidies to the poor sections of society, while the richer sections of society pay the market price. And I think that's the most viable solution. But in the interim, given where we are, we need to have some interim solutions, and perhaps price hike seems to be the only way out right now.
Alright, so what are your fund managers buying in their trading portfolio where they are playing beta, and what are they buying in their absolute return portfolio where they are chasing absolute returns?
I would say it's a relative return market. It's pretty much a stock picking market in that sense. We're looking at valuations very closely. Broadly, I would say we are, if you look thematically, growth is scarce, and we're really, focused on companies where there is visible growth, where earnings growth is definitely going to be far higher than the market's growth. That's number one. Number two is focused on companies with high return ratios, where the potential for the gap between return on capital employed and the cost of capital will, expand going forward. Because we see re-rating or holding up valuations of such companies. Third is very clear case of companies reporting very strong cash flows, and the trend should be positive going forward. This basically cuts across all sectors, and in that context I would say that we have a favorable position on the consumer sector. We do like the cement sector at these levels. We are also playing pharmaceuticals where we are overweight. Banking is a sector where we are focused on banks where the potential for NPA creation is relatively limited, and where they are well capitalized. So that's the broad filter which we are using on the banking sector. As far as commodities go, we are currently, I would say, underweight, but at a particular valuations, we will look at that sector once again. We are still underweight on the infrastructure sector and the capital goods sector. We are basically awaiting triggers for a long period of time. They haven't been in sight. So though valuations are looking reasonable in these sectors, we still think that unless you see a positive trigger, valuations alone cannot be the reason to really buy these stocks. So that's how we are positioned broadly across most of our portfolios.
All right, Alroy, appreciate your time and thank you for joining us.